Tax on mutual funds, how it works, and how to lower the bill. Watch today's program to understand the ins and outs of tax on mutual funds, as well as how to reduce your fiscal bill. Chances are you'll be paying some taxes while you own mutual fund shares and again after selling them. But with the right planning and strategy, you can legally lower the cash you send to the tax man. Welcome back, folks, to another edition of 𝗙𝗘𝗢𝗣. How are you doing today? I hope you are doing fantastic. If you were to ask me, I'm doing marvelous. If you are doing as splendid as I am, go grab a cup of coffee or tea or vodka and let's roll. Today, I want to talk to you about tax on mutual funds, how the whole process works, and how to lower the bill. Let's first talk about tax on mutual funds while you own the shares. A mutual fund combines money from many investors and invests in assets such as stocks, bonds, and sometimes alternative investments. Professionals manage the mutual fund and decide when to buy and sell stocks, bonds, or other assets in the portfolio. The investors own shares of the mutual fund and they pay an annual fee to cover the cost of operating the fund. The value of those shares can rise and fall depending on how the underlying securities in the mutual fund perform. It is very important, before I get into the nitty-gritty here, to explain a little bit what underlying securities means. And let's say you buy a mutual fund right now, and the mutual fund has, say, 10 underlying securities, 5 underlying stocks and 5 underlying bonds. The underlying bonds are just the securities that comprise the mutual fund. So if you buy a technology mutual fund, you might have shares of Tesla, Apple, Facebook, Microsoft, and Amazon, for example, in the mutual fund, and you might have bonds of IBM, maybe other technology companies in the mutual funds. What I'm trying to say here is that the performance of the underlying securities will dictate the ultimate performance of the mutual fund as a whole. So the value that you see every day or every month or every week of your mutual fund shares is a reflection of the performance of the underlying securities. Now, I don't even want to advise you to check the value of the net asset value, the NAV of a mutual fund share every single day. That's just crazy. You want to just leave the market do its thing and check your portfolio probably once a month or once a quarter. You have to pay a fee. As a mutual fund shareholder, you got to pay a fee to cover the cost of operating the fund. Remember, a mutual fund has myriad professionals. I'm talking from the compliance officers to the portfolio managers to the back office, all the admin area. You have lawyers, you have securities analysts, you have researchers. So you have a good mix of talented people who are trying to run the fund. So you have to pay a fee, and the fee is usually a percentage of your investment. So if you invest maybe a 10,000, the mutual fund might charge you 1% or 2% of asset under management. So that's the way it works. Now, let's get back to the situation with taxes here. So 2 things can happen while you own your mutual fund that might generate a tax bill. Number 1, your mutual fund might give you your share of the dividends or interest that the underlying securities paid during the year. And the second scenario is the mutual fund manager might sell some of the securities in the fund for a profit and then give you your share of that profit. If you want more information about the whole, I'm going to give you the gist of the whole process here. But if you want the whole 9 yards, I would suggest you go to IRS.gov and read IRS publication 550. It has the details on the tax rules for investment income and expenses. Let's talk now about the first scenario, tax on mutual funds if you get dividends or interest. So dividends are usually taxable income. So when you invest in a mutual fund, you generally get to choose whether you want your share of the dividends distributed to you or automatically reinvested into the mutual fund. if you opt to reinvest your dividends, the IRS generally still considers that money taxable. Mutual funds that invest in bonds might receive interest payments for those bond investments. So your portion of that interest may also become taxable income, even if you reinvest it. The interest on some bonds, including municipal bonds and U.S. Treasuries, may be tax-free. It is very important to understand that even though you are paying taxes on the dividend income, it's always experts overall would recommend that you have something called DRIP. That's a dividend reinvestment plan. In other words, you are trying to dividend reinvestment plan rather. You are telling the mutual fund manager to convert to use your share of the dividends, to use that portion of the dividends to buy more shares. And it just acts in a very wonderful way. Why? Because you have something called compounding. It's the magic of compounding. So really, the bottom line here is that if you are able, and we have countless of studies that have shown that DRIP works in the long run because of the power of compounding. You are constantly reinvesting, and one thing also you need to know is that how long the mutual fund manager has held the bonds or the stocks that comprise the mutual fund will have an impact on the tax rate that you use when filing your tax returns. So if the securities were held for less than for 1 year or less, then you'll be taxed at your normal tax rate. However, if those securities were held for more than a year, then we're talking about capital gains, and the rate for the tax rate of capital gains, the tax rate for capital gains is lower, way lower than that of normal income. So it hovers around 12, 13, or 15%, depending upon your situation. But let's just say the average is 12.5%. So that's something you need to know. So mutual funds that invest in bonds also might receive interest income. The process is the same, whether you receive dividend income or or interest income. The same applies. Now, if your mutual fund distributes dividends or interest during the year, you probably get an IRS form 1099-DIV for dividends or 1099 INT for interest. You'll get that the following January, showing how much you received from the fund. You use the form to report the income on your tax return. Never ignore these forms, please. The sender gives a copy to the IRS, so the IRS is probably going to notice if you don't report the income. Let's now talk about tax on mutual funds if the fund managers generate capital gains. So if the mutual funds managers, if they sell securities in the fund for a profit, the IRS will probably consider your share of that profit a capital gain. I was just talking about that. I was just talking about the fact that you are going to pay income on the distribution depending upon how long the underlying securities were held. Generally, mutual funds distribute this net capital gains to investors once a year. So capital gains are taxable income even if you reinvested the money. So folks, the whole idea of reinvesting the income that you're getting, whether in a DRIP or in a capital gain scheme, will not exempt you from taxes. So you probably get an IRS form 1099-DIV in January also, showing your portion of the fund's capital gains during the previous years. You'll need this form to report your capital gain on your tax return. Again, do not ignore your 1099-DIV. The IRS is going to get a copy anyway, and sooner or later it will probably realize if you don't report the income. Nowadays, the IRS has fully automated the tax paying process, especially for individual taxpayers. So my advice to you is full compliance, full and honest compliance. So your tax on capital gains earned while you still own shares of the mutual fund depends in part on how long the fund held the investment. One thing I also want to specify here is diversification. folks, it's very important to diversify. And the reason why I chose to emphasize that point right now is because the amount of capital gain you make and ultimately the ROI of your portfolio depends largely upon the diversity of the underlying securities, so that if one part is going down, the other is picking up. And I'm talking here purely from a midterm to long-term play, purely from that perspective. So you constantly want to revise the asset diversification ratio of your portfolio. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of 𝗙𝗣𝗢𝗣𝗑. I hope you are still enjoying this show. We are having a conversation today around tax on mutual funds, how it works, and how to lower the bill. And now let's talk about, so in the first section, I was just talking to you about tax you pay on mutual funds while you own the shares. Now let's talk about the scenario where you sell. In other words, what is the tax on the mutual funds when you sell? So because the mutual fund invests your money in a variety of assets such as stocks, bonds, and real estate, the value of the mutual fund shares and your investment can rise or fall depending on how those underlying securities perform. That I have already explained that. That can lead to taxes when you sell. Okay, this also we have explained. Now, you might sell your mutual fund shares for more than you paid for or more than the cost basis. And usually, if you think about it, that's usually the goal, right? Nobody buys a mutual fund share to sell at a loss, at least ideally. So that profit is a capital gain. So when you sell at a higher value than what you paid for it, it's called a capital gain. Now, capital gains are taxable income. I already said that. Now, if you have, say, a diverse portfolio of several mutual funds, and you sell them en masse or you sell them consecutively, I would say don't worry about the accounting and tax reporting at the end of the year, because nowadays all major brokerages have either an application, an app on your smartphone, or a desktop software that automates the whole reporting and the whole reporting process. So you'll get your 1099 DIV at the end of the year anyway. All right. So the not 1099 DIV, your 1099, you'll get that. Now, it is important that you choose the brokerage where you invest. It is important that you also choose very delicately and very cautiously the mutual fund manager where you're going to put your money, right? There are a few different methods for determining exactly which shares you're selling and how much profit you're making. But with the right software, with the right app, you should be able to determine that. In a nutshell, you can specify the exact shares you're selling if you have the right app or the right software, or the right mutual fund manager. You can decide you can specify the exact shares you're selling, sell the oldest shares first, and use the average cost of all the shares you own. This choice is critical because it can influence how you calculate your profit and how much tax you might owe. How long you own your mutual fund shares also matters. I've said that before. So if you own them for more than a year before selling, your capital gains tax rate may be lower, which is why it's always important to hold mutual fund shares or regular shares or bonds for a while. The whole idea about investing and the whole idea about financial wealth through investing is patience, is long run or medium run. Because in the long run or medium run, I'm talking here 5 years, 10 years, the market always is a winner. The markets will always right you. The market will always make you whole. However, you got to be patient. You can't be looking at your mutual fund shares every day and see if the value of the NAV, the net asset value, goes up or down. You're just going to get sick, and this is not healthy in the long run. Talking about not getting sick in the long run, let's have a short conversation about how to reduce the tax on mutual funds. To reduce the tax on mutual funds, folks, are you hearing me here? Please hear me. You want to wait as long as you can to sell. Selling in less than a year can trigger higher capital gains tax if you make a profit. So you want to buy mutual fund shares through your traditional IRA or Roth IRA. Say if you put money in a traditional IRA, your investments grow tax deferred. By the way, for those who are rookies here, IRA means individual retirement accounts. So if you put your money, say, in a traditional IRA, your investment grow tax deferred. So you're not taxed until you withdraw the money. So if you put cash in a Roth IRA, there are no taxes on investment growth, interest, or dividends if you withdraw them after age 59 and a half and have the IRA for at least 5 years. Buy mutual fund shares through your 401k account. If you put money in a traditional 401k account, taxes are deferred until you withdraw the money. So you got to know what kinds of investments the fund makes. If you don't want a lot of taxable dividends headed your way every year, for example, then you may want to invest in a mutual fund that owns a lot of dividend paying stocks. If you don't want a lot of taxable capital gains distribution hitting you while you own the shares, then you might favor index funds because those naturally tend to buy and sell their underlying investment infrequently. In other words, here you are paying attention to trading frequency, right? Because if you have a mutual fund manager who happens to sell all the time, who happens to be a day trader, I mean, I'm exaggerating here, but the point here is that if they're selling a lot, if they're selling frequently, any sale, any transaction happening in the mutual fund triggers a whole set of taxable consequences for the mutual fund shareholders. So you want to pay attention. You want to read the brochure of the mutual fund before getting into it. So you can also use to reduce the tax. So folks, to reduce the tax on mutual funds, you want to wait as long as you can to sell. That's number one. Number two, you want to buy mutual fund shares through your traditional IRA or Roth IRA. Number three, you want to buy mutual fund shares through your 401k. Number four, you want to do some due diligence. You want to know what kinds of investments the fund makes. Number five, you want to use something called tax loss harvesting. If your investments are in a taxable account, you might be able to offset some taxes by selling other underperforming mutual funds or securities at a loss. So those losses can offset some or all of your investment gains. That's what tax loss harvesting is. Another way to reduce your tax on mutual funds, even though this is not a direct strategy, but it is to see a tax professional. Folks, just understand that this show is not about giving you a fiscal advice here. We have done research and we are just giving you the results of that research. And it's always better. Everybody has a unique personal and fiscal profile. So you want to contact a professional, not just to reduce your tax on mutual funds, but just for general guidance, because there are other ways to minimize your mutual fund taxes, but only a qualified tax professional can help you look at your situation and discuss your options with you. All right. Thank you so much for listening to this conversation. I really appreciate it. And let me just do a quick recap of what we talked about today. I spoke to you about tax on mutual funds while you own the shares, tax on mutual funds if you get dividends or interest, tax on mutual funds if the fund managers generate capital gains. I also talk about tax on mutual funds when you sell. And the third category, I just explained to you how to reduce the tax on mutual funds. I will see you next time. But until then, remember, stay splendid.